Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cavco Industries, Inc. quarterly report. Cavco Industries, Inc. is a leading manufacturer of factory-built homes in the United States. The company operates in two main segments, factory-built housing and financial services. In terms of housing products, Cavco produces a wide range of structures, including park model RVs, vacation cabins, commercial buildings such as apartment complexes and hotels, workforce housing, schools, and military housing. In addition to its housing products, the company also offers various types of modular homes, including single-family ranch-style homes, split-level homes, Cape Cod-style homes, 2- and 3-story homes, and multi-family units. These homes are designed to meet the needs of different consumers, from individuals to large families and communities. Cavco's financial services segment provides financing options for homebuyers through conforming and non-conforming mortgages and home-only loans. The company also offers property and casualty insurance to owners of manufactured homes, providing an additional layer of protection for its customers. Overall, Cavco Industries, Inc. is a comprehensive provider of factory-built housing solutions, offering a range of products and services that cater to different needs and preferences. Cavco Industries, Inc.'s stock price dropped by approximately -7.7% on February 2, 2026, primarily due to its disappointing third-quarter fiscal year 2026 earnings report. The company reported adjusted earnings of $5.58 per share, missing analyst estimates of $6.26, and revenue for the quarter was $581 million, falling short of the consensus estimate of $593.35 million. The decline in stock price began after hours on January 29, 2026, when Cavco's shares fell 4.5%. The downward trend continued, with a reported drop of 14.5% by January 30, 2026, coinciding with the earnings call. This culminated in the -7.7% drop during trading on February 2, 2026. Despite an increase in net revenue by 11.3% compared to the prior year, primarily due to higher home sales volume and average selling price, the overall income before income taxes was down 16.9%. The diluted net income per share also decreased by 19.1% to $5.58, compared to $6.90 in the prior year quarter. These misses on earnings and revenue expectations were significant factors in the stock's negative performance. Cavco Industries, Inc. market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $6 billion. Cavco Industries, Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 3.41 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of the financial statements provided. On the revenue growth side, several key factors contributed to the increase in revenue. Firstly, net sales rose by 9.6% from $1,044,919 in 2024 to $1,1 $144,111 in 2025. Additionally, gross profit increased by 16.2% from $294,511 in 2024 to $341,419 in 2025, with a corresponding improvement in the gross profit margin from 28.2% to 29.8%. The factory-built housing segment was a significant contributor to revenue growth, with home sales increasing by 17.1% and financial services experiencing a 58.5% rise in insurance agency commissions. The acquisition of American Homestar also played a crucial role in driving revenue growth, contributing $42 million in net revenue for the 3 months ended December 27, 2025. Furthermore, forward sales commitments decreased from $20.8 million to $10.6 million, while interest rate lock commitments increased from $16.3 million to $36 million. These factors collectively contributed to a significant increase in revenue, with the consolidated net revenue rising by $1,694,378. In contrast, there are no drivers of revenue decline mentioned in the provided financial statements. However, it is worth noting that factory-built housing SG and expenses increased due to American Homestar addition and acquisition-related deal costs, while financial services SG and expenses rose primarily due to compensation increases year-over-year. Net income for the company experienced a decline in Q3 2025 compared to the same period in 2024, with a decrease of $12,395. However, when looking at the year-to-date YTD figures, net income actually increased by $13,384 from 2024 to 2025. This discrepancy can be attributed to the company's performance in Q3 2024 being unusually high. The profit margins also saw a decline in Q3 2025 compared to the same period in 2024. The gross profit margin decreased to 23.3% from 24.9%, while the operating profit margin dropped to 10.1% from 12.2%. These decreases can be attributed to several factors, including inflation in material costs, shortages in availability of materials and or labor, and production inefficiencies. The effective tax rate also played a significant role in the decline of net income and profit margins. The company's effective tax rate increased to 23.5% from 18.6% in Q3 2024 and to 22.1% from 19.9% in YTD 2024. This increase in tax rate contributed to the decrease in net income and profit margins. In summary, while net income saw an overall increase from 2024 to 2025, it declined in Q3 2025 compared to the same period in 2024. The decline in profit margins can be attributed to a combination of factors, including inflation, shortages, production inefficiencies, and an increased effective tax rate. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has increased from $139,851,000 in the 9 months ended December 28, 2024 to $200,119,000 in the same period of 2025. This significant increase suggests that the company is generating a substantial amount of cash from its core operations, which is a positive sign for its financial health and stability. The company's debt level has undergone some changes over the past year. While total debt increased by $66,532, there are mixed signals regarding commercial loans receivable. The decrease in originated commercial loans receivable was more pronounced in 2025 compared to 2024, but principal payments received on these loans also saw a significant increase. On the other hand, interest expenses have decreased significantly. The company's interest expense dropped from -$155 in 2024 to -$131 in 2025, representing an overall decrease of $24. This change translates to a substantial increase of 586% in interest expenses, indicating that the company is paying less interest on its debt. The company's performance across various segments has been mixed. On the positive side, the factory-built housing segment has shown strong results, with revenue of $558,497 and a gross profit of $121,255. This segment also reported an income from operations of $47,093, indicating healthy profitability. In contrast, the financial services segment has underperformed, generating only $22,497 in revenue and a gross profit of $14,666. The income from operations for this segment was $7,467, which is significantly lower than the factory-built housing segment. These results suggest that the company needs to focus on improving its financial services segment to achieve overall growth and profitability. Management is optimistic about the company's outlook, citing several key points that highlight its strategy and financial position. The acquisition of American Homestar is expected to have a positive impact on earnings and cash flow, demonstrating the company's commitment to growth through strategic investments. The company's focus on developing the home-only loan secondary market and expanding its presence in the manufactured housing industry suggests a deliberate approach to increasing revenue streams and market share. This expansion strategy is likely to drive long-term growth and profitability for the company. In terms of liquidity, management is confident that it has sufficient funds to support operations for at least the next 12 months, with potential for further investment opportunities arising from this position. The company's willingness to explore additional or alternative sources of financing underscores its flexibility in responding to changing market conditions and strategic priorities. Overall, management's comments convey a sense of confidence and forward thinking as it continues to evaluate new acquisition targets and investments that align with its growth strategy. The company has engaged in significant share repurchases over the past 2 years. According to financial records, a total of $244 million was spent on buying back shares in 2025 and 2024. This substantial investment resulted in the purchase of approximately 80.6 million shares. While there is no specific information provided regarding dividend payments, the company's focus on share buybacks indicates a strategic approach to managing its capital structure and potentially enhancing shareholder value through increased ownership stakes. Concerns about inventory buildup and supply chain disruptions are valid. The current situation indicates a significant accumulation of raw materials, work in progress, and finished goods. This buildup is causing periodic shutdowns due to shortages in materials and labor, as well as production inefficiencies resulting from delays in material delivery. Furthermore, there is potential for supply chain disruption, which could exacerbate the existing issues. If not addressed promptly, these concerns may lead to more severe consequences, including increased costs, reduced productivity, and compromised customer satisfaction. That concludes the financial summary for Cavco Industries, Inc. Feel free to comment below, and I will be happy to answer them when possible.